Welcome, and thank you for tuning in to Policy Pulse, a KBRA podcast series highlighting regulatory developments that may impact global financial market participants. I'm your host, Emilie Nadler, a director on KBRA's investor relations team with a focus on regulatory affairs. This podcast series gives you insight into the latest regulatory trends and upcoming changes to global financial policy. Join us as we navigate the complex regulatory world and offer perspectives from industry leaders, key investors, and policy experts.
In this special crossover episode of Policy Pulse, I'm joined by KBRA's chief strategist and host of the weekly Three Things in Credit podcast, Van Hesser, as well as KBRA's European macro strategist, Gordon Kerr, who hosts the podcast Credit Compass, Navigating European Credit Markets. In this episode, Van and Gordon join me to discuss the current policy environment, including how the U.S.'s policy agenda is influencing regulatory priorities in the UK and the EU, and the potential long-term impact on credit. Hi, Van and Gordon. Thanks so much for joining me today. Van, I'm going to start with you. So as I mentioned in our intro, you have a weekly podcast, Three Things in Credit, that discusses current credit trends and market dynamics. There has obviously been a lot going on in the U.S. That I know that you've been watching closely and providing a view on the potential market implications each week. But for our Policy Pulse listeners, what are some of the things that you're watching in the current political environment to understand long-term credit trends and implications?
Plenty to talk about there, Emily. Nice to join you on the podcast. So as you can imagine, economic fundamentals and firm or asset pool dynamics are what typically drive credit markets. Policy effects are usually limited to monetary and fiscal developments, and those tend to show up at turning points in the economy. So what we're going through in this go-around has sort of a novel implication to it. So I probably don't have to tell our listeners that this time is different, right? The broad policy agenda of the new U.S. administration is a bold attempt to reset the global economic and political order that has largely been in place since the aftermath of the Second World War. The policy goals are to adjust terms of trade around the world in an effort to reshore manufacturing capability in the U.S., to achieve energy dominance, and to reduce government interference in commercial activities. Pretty wide sweeping list. All right, so what is impacting credit markets? Well, of course, tariffs, which have created a high degree of uncertainty among economic actors, businesses especially. Now starts the parade of trade deals, where it will be interesting to see just how much impact on growth tariffs will bring. And next up is the big, beautiful bill. That's tax cuts and what promises to be a highly contentious debate, which brings back debt ceiling and prospects of government shutdown. So there's an awful lot in flux at the moment. As I mentioned, it has created significant uncertainty and made planning, especially for businesses, very difficult. Again, I think the administration would hope to move through a lot of this uncertainty over the balance of 2025. How successful they will be in doing that is very much a question that investors are having at the moment.
Thanks for that, Van. That's really helpful to just frame our discussion today. And so, Gordon, I want to ask you, you also have a podcast, as I mentioned in the intro, Credit Compass, Navigating European Credit Markets. So I know, again, you're watching U.S. political developments very closely to understand potential implications for the UK and European market. Can you talk from a European perspective about the things you're watching in terms of the U.S.'s regulatory trajectory under Trump?
Yeah, thanks for having me on, Emily. Absolutely. From a European standpoint, there's certainly significant attention on U.S. actions at the moment in the headlines, and where we and a lot of market participants' attention is focused on trade policy, as Van highlighted, especially tariffs and bilateral negotiations. The UK and US have managed to reach some form of an accord, and there's hope that Europe will follow. But while trade negotiations do involve regulation, think of non-tariff barriers like food safety standards, that's not really at the heart of your question. Nonetheless, this really is about a direction of travel, which is the America First policy and a migration towards greater deregulation on your side of the pond. In terms of credit markets and financial regulation, what we're watching closely is how any U.S. policy shift might ripple across to impact us here. Europe, in the aftermath of the global financial crisis, implemented stringent frameworks like the Basel reforms for banks as well as Solvency II for insurers, although that was really already in process at the time of the financial crisis. But these reforms have strengthened capitalization across European financial institutions. But if the US begins to roll back its own regulatory efforts on this front, that could tilt the competitive landscape, especially in areas like capital flows, risk-taking, and credit formation. For example, an insurance in the US operates under a risk-based capital framework governed by the NAIC, while we have Solvency II. Any sort of deregulatory moves in the US could affect US and global insurers' capital allocation strategies, which includes their investments into European credit markets. On the banking side, the regulatory regimes are more similar in both regions, and we're in a bit of a regulatory limbo there. Europe was preparing to implement what we colloquially call Basel IV, though the US coined the term Basel Endgame. That process has now been paused in the US, which in turn has prompted both the UK and the EU to delay full implementation as well. The irony is that many European banks were already largely compliant, so we're monitoring whether the US decides to reverse or dilute any of these reforms, as that could create significant regulatory divergence. The pause alone has already created a divergence and competitive advantage to the American banks, given most European banks were already compliant.
Gordon, I want to stay with Europe for a minute because I also want to ask you, how is the Trump administration's deregulation efforts influencing European and UK policy, if at all? Is it changing the conversation around things like competitiveness and innovation?
The short answer is yes, though in a distinctly European fashion. We've seen some softening, for instance, around ESG disclosure rules. Certain upcoming mandates were scaled back, particularly for smaller corporations. And there hasn't really been much beyond that as of yet, but there is a broader shift underway. Ursula von der Leyen has introduced a strategic framework called the Competitiveness Compass, building on proposals by the former ECB president Mario Draghi. The agenda really focuses on several pillars, but for the financial sector, the key objective is mobilizing capital more effectively. One outcome of this is the transformation of the Capital Markets Union, which was an initiative that had stalled, into what is now being called the Savings and Investment Union. And the goal here is to deepen European capital markets, which still remain fragmented and small relative to the US system. We're also seeing adjustments to the securitization rules and efforts to streamline regulation under what's been called the Omnibus Simplification Package. This was also a recommendation from the Draghi report, and here there are targets to reduce administrative burdens of companies by 25%, rising to at least 35% for SMEs. Further, the European Central Bank has launched a task force to reduce the complexity of banking regulation. And that's really no small task. The regulatory code is absolutely massive. The capital requirements regulation is nearly 900 pages alone, and adding in the rest, you're up to over 1,300 pages in regulation for banks. Also, one aspect that relates to your prior role in ESG, Emilie, here regulations are not being rolled back in the way that you might think. Yes, there is a rollback in the administrative compliance burden, but the drill baby drill policy in the US will not be a competitive priority in Europe. Europe is still working towards total independence from Russian gas and towards cleaner and cleaner energy, and I do not expect that to really change in any major way. So in summary, yes, while there is still a long road ahead, the momentum is towards greater simplification and efficiency in regulations in Europe, and that is largely in reaction to the US developments.
Van, I want to get your thoughts. So, how do investors generally tend to react to geopolitical uncertainty? And is the current market uncertainty affecting capital flows between the US, the UK, and Europe?
Yeah, so the whole issue of geopolitical risk is something that investors are clearly aware of, and yet I think over the long period of history, you tend to recognize that most geopolitical events don't rise to the level of influencing risk premia in capital markets. Now they can when you've got a disruption to supply and demand. That's where the geopolitical environment tends to bleed into markets, is when there's an economic shift. And again, that can, take oil production, for example, that, as it ebbs and flows, oftentimes driven by geopolitical events that can affect the price of oil. It bleeds through to the economy. So that's where we as market participants tend to focus our attention, is where you start to see kind of economic activity being altered because of that event. Now, when we talk about everything that's going on, as if we accept as our sort of base case that the Trump administration is looking to reset the global geopolitical order, I think it has highlighted that investors have become maybe overly invested in the US, whether it's in the treasury market, whether it's in the dollar, or whether it's in corporate credit over the last 5 years or so in kind of the pandemic and post-pandemic era. You've seen massive flows into US risk assets, which has given rise to this label of this particular era as being, US exceptionalism. Now, some of that US exceptionalism, I think, is well earned, right? I think, and as Gordon mentioned, the heavy regulatory burden that has probably hamstrung European capital markets from getting capital to its most productive use. In the US, it's been just the opposite, right? The US financial system, I think, is really the root of US exceptionalism, because we do find our system far from perfect, but it is markets-based, it is decentralized, it's bank, non-bank. It tends to get capital to its most productive use. And that, of course, has driven the productivity gains that we've seen in the US, superior to those elsewhere in the developed world. And it's brought about this great record of innovation, which again has really been the growth engine behind the US economy over the last couple of decades. This particular event also introduces the issue of trust into the mix, right, with global investors. So trust being, how much can you trust the US system in its current form to remain very favorable to global capital flows? I think that's caused a lot of global investors to rethink their concentration in US dollar assets. So I do think we've seen some significant flows. It's been sort of labeled a sell America trade here in the wake of the tariff announcements as sort of the catalyst. But I think, again, global investors are really rethinking their concentration of investor dollars into the US, or investing resources into the US. And I think there's a very natural rebalancing that is taking place. Again, the catalyst has obviously been the tariff rollout, but I think it has gotten investors to, quite frankly, direct some investable resources away from the US and into the UK and Europe.
Thanks for that, Van. And that leads really nicely into my last question, which I'd like to get both of your thoughts on, which is, do you see the US's sort of isolationist stance and move away from globalization leading to further divergence in global financial regulation, and what are the implications for cross-border investments and market access over the longer term? Gordon, I'll start with you, and Van will end with you.
Sure, yeah. So I think there's two aspects to the response to this. One is the US movement is sparking a reaction in other parts of the world to the US changes. So as I highlighted in my earlier answers, Europe is reacting and is changing, and it is responding to the US administration changes. So that means that we will see a potential for deregulation elsewhere. It may not happen in the same way that it happens in the US, and it may not go as far as it may go in the US, but it is spurring a reaction from Europe and the UK. In terms of the picture for capital flow, that in terms of cross-border investments and market access, as Van highlighted, that's already started to change. And we think that that will continue to change. Europe is likely to be a beneficiary of that. It already has been. The reason for that is that it's another location, although it's not got as deep a capital markets as the US. It does have a stable and predictable administrative environment. As much as you may not like the heavy regulatory burden for some companies, it is at least a stable, predictable place in which to operate. And so as a result, we are likely to see some of that capital flow head towards European opportunities. And we are likely to see that continue as there is a potential for a growing divergence.
Yeah, I would say, and I really, as a former bank analyst or a recovering bank analyst, but I've watched sort of the deregulatory moves over the course of the last really 30 or 40 years. And I think we've gotten to a point where I think, and especially in the wake of the GFC, there was a move towards trying to really make sure that there wasn't a race to the bottom in terms of regulation across the financial system. I think there's an acknowledgement among developed world jurisdictions that the financial markets are global in nature, that you really don't want one jurisdiction with a lot of regulatory freedom versus the others, because you then tend to get this race to the bottom effect. Now, to be clear, I think the US is probably, under the new administration, there's some energy behind the deregulatory initiatives, especially in financial services, that are likely to gain steam here. Some of this, and a lot of it, is maybe geared towards regional and smaller banks, which have been heavily burdened post the GFC with regulation that was really designed for much larger banks. So I think that's where a lot of the energy is going to go, and it's sort of reduce that regulatory burden off of our thousands of smaller banks in the US. I think with the larger banks, there's a belief that we've had this sort of stacking effect of regulation post the GFC, where, with every single issue that comes up, the answer always seems to be, well, it's more regulation and more capital. I think it's reached probably suboptimal degrees. You've heard some of the leaders of the big banks, Jamie Dimon in particular, has been very vocal about this, that a lot of this regulation now is working at cross purposes across banks, and ultimately does create an unlevel playing field, or risks that, especially with markets going forward. And so I do think that we're going to see still ideologically a drive that we need to have the largest banks and financial markets kind of harmonized in terms of their positions really across the world. It doesn't mean that we're not still going to have some room, each jurisdiction, to make their own adjustments. That's always been the case. But I do think that we're largely going to start to almost take a step back, try and figure out what we've had post the GFC, and try and optimize better the financial regulation that we do see across both banks, non-banks, and markets going forward.
Thanks for that, Gordon and Van. And certainly going to be interesting to watch how this unfolds over the next few months and few years. But I want to thank you both so much. I think this has been a very enlightening episode to understand some of the market dynamics around the current U.S. administration and how that's affecting policy conversations in Europe. So thank you both for joining me on this special KBRA podcast crossover episode.
Thank you.
Thanks, Emily.
This concludes our episode. Thank you for tuning in. New episodes of Policy Pulse air every month. In the meantime, please visit kbra.com to access our other podcast series, as well as our ratings and research.